Alrighty, it's now 2 o'clock Eastern Standard Time, and once again I want to welcome everyone to the webinar, and this is going to be a market overview on Sunday, July 12th, 2015. It's going to be conducted by myself, Dane Gunn, and just want to welcome everyone to the webinar. First off, good morning if you're in Pacific Standard Time, good afternoon if you're in Mountain Standard Time, Central Standard Time, or Eastern Standard Time. So let's go ahead and get this started. Okay, so first off, I need to basically kind of give you guys an overview of what's going on. There's currently a lot of volatility in the markets, and first of all, we want to look at what is causing the current market volatility. Okay, I think the number one driver as far as volatility goes right now is China's bear market correction. Okay. Earlier this year, or actually earlier this month, China was actually trading at 24 times earnings per share across the entire market, which is definitely a bubble in my opinion. Just massive gains created through 2014 till now. The markets at its peak was up over 150% from the start of 2014 to the peak. So another thing we have going on is the Greece debt crisis. Okay, I was actually checking in on that before the webinar started, and I noticed that basically there's been another delay. It's the next deadline is now Wednesday for a final deal. So I think that might bring a little more volatility to the markets, and we'll see how the futures react a little bit later on today. Puerto Rico debt crisis, also another issue kind of looming over the markets. Definitely a bigger debt number than Greece has, and it's it's part of the U.S. So I think that could bring a little more volatility to the U.S. as well. Starting to see some hints of slowing global demand for commodities. Typically, that's going to signal a recession. We'll see how things play out. I don't know if we've really been given enough data to confirm that or not, but that's something I've been looking at. Now, one thing that's not good for U.S. stocks is a strengthening U.S. dollar, and that's not good for commodities either. So, these are the things that we're kind of looking at as the most important factors, and what's basically driving the volatility, not only in the global markets, but in the U.S. Equity market as well. Okay, so let's go to the charts. The first thing I want to show you guys here is a daily chart of the S&P 500. Okay, the ticker is SPX, as you can see up here in the top left corner. So I just wanted to highlight a couple things and walk you guys through a couple things real quick. So this is the correction that we had at the end of the summer last year. Correction happened in September, and this top line right here is the 50-day moving average, and this red line right here is the 200-day moving average. And as you can see, it broke down through the 200-day moving average pretty well and had an absolute V-shaped recovery from that bottom. So something to, a couple things to take a look at, and we broke through the 50-day moving average a number of times since then. So you can see there's a couple points that came through. You can see the sell-off that we had in February this year, when we came down, touched the 200-day, and had a very nice, bullish market for a solid couple months after that. Now, this is where we are right now. We actually broke through this bar right here. You can see it was actually the biggest sell-off day that we've had in 2015 so far. So let me I'm going to go a little deeper in here, and you can see how I have this alert set up right here in Thinkorswim, just because that's been a pretty strong top. It's been tough to come through that so far. Time will tell what's going to happen with that. And the interesting thing is the peak, the high of 2134 on the S&P 500 was also an exact Fibonacci retracement from the bottom of 2008. So that was a 161 retracement on the Fibs too. So there's definitely a couple things that are kind of holding back the markets this year. Now, if we can go up and break through this, I think it'll definitely be back to kind of a more consistent bull market. But as you can see, we've been pretty volatile this year, and with the close on Friday, we were just at a negative return throughout the year so far. So these are things I look at daily just to kind of see the overall market sentiment, just to make sure our technicals are in line, and kind of get our basis from that. Here's a little more zoomed in version of the daily as well. You can see that this was Friday, Thursday, Wednesday, Tuesday, and Monday of last week. So still volatile. We are putting in some higher lows, but we also are very close to the 200-day moving average. So things are definitely shaky in the markets currently. So now I wanted to go to the Russell 2000 ETF, and the ticker for that is IWM, which you can see here in the top left corner of my screen. And you can see that over that same time frame of this year, it's been a little less volatile than the S&P 500, and this is a good sign for basically how I base my system. Is we're thinking with the strengthening U.S. dollar that the smaller stocks are going to be the safest place to go, okay, because they're not going to have global exposure, and the U.S.'s economy is still looking pretty decent. It's definitely not anything I would call strong, but it's decent, and it's still looking okay. And so it's kind of nice to see the comparison where it hasn't quite come down as far. So that's a good sign, and we'll see how things kind of shape up throughout the coming days, weeks, and months. Okay, so here is a little more zoomed in version of the same chart, and you can see it actually didn't touch the 200-day moving average, unlike the S&P 500 did. And you can actually see too that we're right at what is now a resistance on the 50-day moving average for the Russell. Okay, so just kind of, I always watch the Russell as well. I every single day I'm looking at what the S&P 500, SPX is doing, and what IMW is doing. Just so we can kind of get a general gauge of market sentiment. Okay, so now I'm going to kind of go into a closer look into ONCS, one of the positions that we have open currently, and we're down on it. But I just kind of want to show you why. Technically I like this stock where it is. It's kind of really at a deep discount right here, and this is a 3-year chart I'm showing right here. And so the low was put in, way back in 2010. Let's see here at $3.46. Had a really nice run in 2013 all the way up to $19.40. They've made some progress in their company between here and there, and this is why I basically recommended that we get into the stock. Definitely has a massive pipeline, and biotechnology in the United States has been one of the best places to be consistently for the past, since I think since the 2008 correction. If you would have bought the IBB index, the low was $52 that year, and the IBB's trading north of $350 right now. So definitely, outpaced the S&P 500 over that time, by a great measure. And the fact that we have so many baby boomers hitting critical health stages, I think will keep the demand really high for the healthcare sector, definitely, and for the biotechnology industry. It's just, it's a nice macro demographic we have to look at, because the boomers aren't getting any younger, and unfortunately, the older you get, the more prone you are to have health problems. So little just kind of 10,000-foot overview on ONCS. I'm going to go to the next slide here, and so I want to show where we got in. I thought we were catching a breakout basically when I recommended the position, Then we got the geopolitical stuff that happened with Greece and with China, and pulled the markets down. Pulled everything down with it a little bit. So we actually entered the stock at $7.20, and if I see ONCS trade under $5 or at or under $5.50 a share, I'm going to recommend that we actually add the same amount of shares that you initially bought at 720 or somewhere in that area. So we basically build a pyramid on that position, okay? Because I really think this stock can do well over $10 before the end of the year, if not much more. So I'm going to go over this real quick. Yeah, if we see ONCS dip below $5.50, we will add the same amount of shares originally bought and build what I call a pyramid position. Okay, I'm officially moving the mental stop and simply recommending to buy more at cheaper prices if we see them. One of my favorite quotes of all time from Baron Rothschild is, "The time to buy is when there is blood in the streets." We will be executing on this plan if we get the opportunity. Okay, so another thing I've been looking at and kind of researching quite a bit is the bear market that's going on in China. Kind of some striking statistics you see here, but just since we've had the correction in China, there's been $3.9 trillion wiped off of the Chinese stock markets. And when you look at this in comparison to Greece, Greece's total bailout deal when they raised their limit to 58 billion, kind of makes that seem like small potatoes when you look at what China's doing. And in the last couple of weeks, you've seen the U.S. market react to what China's doing, okay, what they're trading, and this is why. Much bigger numbers. A lot of people are kind of looking in to see if China is really slowing down hard, and if that's the case, then maybe that's the start of a global type of recession. But so we go to the next slide here. So here's some details from Bloomberg. The Shanghai Stock Index composite has lost 28% since its peak on June 12th. Okay, so in just over a month, a 28% correction has happened. If you kind of put that in perspective, if S&P 500 did that at these levels, we'd be trading close to 1,800 and not the 2,000 level that we've been floating around this year. So about 3.9 trillion in market value has evaporated, more than the total annual output of Germany, the world's fourth largest economy, and 16 times Greece's gross domestic product. Okay, the benchmark is still up 82% in the past year, the most among the world's major markets. So that tells me that we have some more opportunity to the downside in China. Okay, wild suspensions. Over half of the stock in China have been trading for their trading's been suspended. You can't buy or sell the securities. Pretty crazy things when all of a sudden half the vehicles in that market can't be utilized. So some more details here from Bloomberg. As shares tumbled, companies rushed to apply for trading suspension. More than 1,400 companies stopped trading on mainland exchanges, locking sellers out of 50% of the market. The China Securities Regulatory Commission, it's basically China's version of the SEC, also banned major shareholders, corporate executives, and directors from selling stakes in listed companies for 6 months. So some major actions, being implemented by the communist government in China to try to stop the bleeding. And just don't think that that's, what I really think is it doesn't matter what they do at this point. It's got to sell off even more than it has. So, so just to give you a perspective on volatility, we're seeing some serious volatility in China. The volatility is actually 5 times bigger than the S&P 500. So, I mean, you can You can, I've been looking. It's kind of crazy on a daily basis. The Chinese markets are swinging, 7-8%. And to give you perspective, that's if that happened on the Dow, that's 500 point plus moves in a day. That's you're looking at 1,000+% moves, or 1,000% moves on the down a day. I mean, so that'll kind of give you a little perspective. So details on from Bloomberg on that. Chinese stocks have become the most volatile among major markets after Greece. A measure of 30-day price swings on the Shanghai benchmark reached 56, the highest since 2008. The volatility is more than 5 times that of the S&P's 500 stock index. Okay. Outstanding margin debt. Margin loans is now hit $232 billion. Last week, China put out a new, I guess, corporate parameter that says that now you can basically fully margin the cost of your house to be able to keep buying stocks, which is to me just signals, be careful. And be careful in a big way, and also a short opportunity. Okay, can this be fixed? So far as of Thursday of last week, they had injected $19 billion to help basically stop the bleeding and help boost stocks on Friday. The Chinese markets got a little bit of a boost from that. Obviously, you can see exactly why. Okay, some details from Bloomberg on that. Officials have unveiled a market-boosting measures almost every night in the past 2 weeks. A group of 21 brokers has pledged to invest at least 120 billion won in a stock market fund, taking a page from the playbook used by JP Morgan and Guaranty Trust Co. during the 1929 U.S. crash. Regulators have banned major stockholders from selling stakes in listed companies, suspended initial public offerings, and restricted short selling. So, complete market manipulation by China's government, basically. What's my take? I believe China's markets will continue to correct further after capital injection programs fail. Okay, so I'm anticipating that they, maybe get a bid for a couple more days, possibly a couple more weeks, but that's all going to go away. And so I found some neat correlations with what's going on in China, what kind of happened in 2008 and 1929. But all great bubbles start out as legitimate and compelling economic growth booms. The U.S. Roaring 20 bubble started as growth boom based on the commercialization of radio, automobiles, and mass production. Japan's 1980 bubble grew out of their post-war economic miracle that was spurred by groundbreaking advances in electronic technology and manufacturing. The dot-com bubble evolved out of the information age boom that revolutionized society in an incomprehensible number of ways. The fact that all of these booms started out legitimately didn't prevent them from developing into bubbles that popped disastrously at the end. Okay, the reforms and modernization that helped to lift hundreds of millions out of poverty while eventually developing into an orgy of wild real estate speculation, reckless construction of empty cities to create economic growth, and materialism mania. Even China's long-term growth thesis remains intact. The same way this is also true in the U.S. in 1929. China could conceivably experience a Great Depression of its very own when a bubble pops. Okay, do you see any similarities here? I think it's pretty obvious that we do. Okay, how will we position into the theme? So one of the vehicle that I've picked out that I've liked to position into this theme is ticker symbol YANG, and it's basically the 3 times bear market ETF. So it's going to be a triple levered ETF, and you can see here how volatile it's been. I mean, down here, just 2 weeks ago, the index was, or the ETF was trading in the high 50s. As you can see on Wednesday here, it actually hit a peak, I believe, of $108. So I mean, look at 1, 2, 3, 4, 5, 6, 7, 8, 9 days for that to happen. I mean, that's a major move. And this particular investment vehicle also has options, which is nice as well. So I'm going to see what happens throughout the the next coming days and weeks. But when you get a trade alert, it very well could be that we're entering a position on Yang, okay, to take advantage of the short side of that market. Okay, so here's a little profile on the trading ETF. The vitals on it. The issuer is Direxion. The structure is an ETF. Expense ratio is 0.95%. Okay, the inception, basically the ETF was created in December 3rd of 2009. Tax form is a 1099. And it's the Bank of New York Mellon China Select ADR Index. Okay. And so I want to go over here, and you can see the 52-week low was $48.80. That low was put in the same day that China hit its peak. So you can also see here that the 52-week high is $192. Now there was a split that happened, so that's really not the most accurate measure. For all intents and purposes, you can kind of figure, $50 really to $108 is the range that I've been kind of focusing on. I think we could break well out of that 108 range, and Yang closed in the high 80s on Friday. So I think we'll be able to pick up Yang possibly in the mid 60s to low 70s. So anyways, keep an eye on your email inbox. It's definitely going to be something I'm looking at on a daily basis, and basically researching as much as possible. Okay, so it's the asset size. It is a large cap, so the bigger guys and our members, the guys that have bigger accounts, this is something you could, if you trade $1 million account, you'd have no problem adding a 10 to 20% position to this. Very liquid. So some more details. The BNY China Select ADR Index is a free float adjusted capitalization weighted index designed by the Bank of New York to track the performance of a basket of companies who have their primary equity listing on a stock exchange in China, and which is also have depository receipts that trade on a U.S. exchange or on the NASDAQ. Okay. Real-time rating summary. Yang is a leverage ETF that is linked to Direxion. The BNY China Select ADR Index is a free float adjusted capitalization weighted index designed by the Bank of New York to track the performance of a basket of companies who have their primary equity listings on the stock exchange in China, which also have depository receipts that trade in the U.S. on the NASDAQ. Okay, so yeah, that's basically what I am looking at. I think this is one of the better opportunities that I see in the market. Things are real volatile, obviously, as we've seen, and we'll see what what the next week brings. But I think one of the safest positions we can get into is shorting the China markets. So, and we'll be using Yang to do so. Just kind of waiting to see, how much capital injections props the markets back up. But I think everyone that can sell is going to be selling. And just it's kind of it's a whole different really psychology in the Chinese markets too. They are big on gambling in China and most of Asia for that matter, but they treat investments, I think, a little bit more like gambling, and probably don't quite have the risk parameters as much of the other global markets from what I've seen. So it's going to be a big hangover in China is basically what I think. So okay, I'm going to see if I had any questions here from our members, and do my best to get to them real quick. And also the next time we have a webinar, guys, if you can send me your questions to support@stocktradewire.com before the webinar starts, I would definitely greatly appreciate that. That way if it is a pretty complex question, I can get some charts together for you. I can really get into some deep research and give you a full detailed answer on the webinar. Now, I did have a question from David Cauldron, and he basically had a question about ONCS, and he has actually started to build a pyramid down, which I was real happy when I read that. So he's already thinking in the same way that we are. So good job, David. You definitely have a nice trader instinct there, building your pyramid down. So good job on that. And I wanted to read a couple of questions here. So how do you determine when to enter a stock? Well, it's going to be a couple of different things, really. But in the simplest answer, it's going to be a mix of technicals, so technical analysis and fundamental analysis. Okay, I want to basically identify that that the stock or ETF or ETN is basically either in a period that there's been a lot of money flowing into that particular sector or industry, okay, or theme, or basically that things are at a deep discount and we can buy something that's on sale, basically, okay. And the only time we're going to do that is if also our fundamental lines up with that as well. We want to make sure that the company's something that that can basically just something that's a theme that we think is going to continue, not just a very short-term trend. Okay, so yeah, that's how we determine if we enter a stock. Let's see here. I think that's the only question I see currently. If you guys do have any questions, feel free to type them in the GoToWebinar box on the right-hand side of your screen. I'll be happy to get to those. And also, if anyone has any questions after the webinar's done, feel free to always email support@stocktradewire.com. I'll be more than happy to answer any questions you have along the way. Okay. Let's see here. Another question I had from Mark is, how often do you trade stocks below $5? Well, Mark, it's currently this year we've traded quite a few stocks under $5. And one of the reasons why I like trading, these basically the smaller cap stocks is because of all the headwinds that we have on a global basis. Okay, so the stronger dollar doesn't really hurt companies too bad, or not nearly as bad as the large international companies, if it's just a domestic-based business. Okay, basically, the strengthening of the dollar doesn't affect the small caps as much because the market's in the U.S. and that consumer is directly tied to what's going on here. If you look at shares like Apple, when China started selling off, it definitely got crushed more than other companies. And if you listen to any of the earnings calls throughout the earnings quarter we have right now, almost every single CEO is saying that basically they would have done better if they wouldn't have had such a strong dollar. Okay, so definitely a couple things that I look at, and really, Mark, below $5 is just that's just a price point. Price really has nothing to do with value in my mind. And another reason why I like buying the smaller cap stuff here is when they actually get beaten up, or if they come out with a product that's really hot and kind of disruptive in the industry, the big guys just come in and buy them. Global merger and acquisition activity is actually up 28% this year. So a lot of these smaller cap guys are getting bought out, and I think there's also going to be quite a bit of opportunity in the oil area. I have a list of about 20 companies that are pretty solid, and really 5 that are very, very solid that I like. And depending on how oil shapes up through the next couple of weeks, we might be entering into some of those as well. Most of those stocks are going to be under $5. Okay. And just kind of as a general basis, most of the actual stocks that we'll trade, the actual equities, is going to, most of them will be under $20, just because that's kind of where I look. Okay, that's where you have huge growth opportunities. You know, once it's kind of the law of relativity. Once this company gets so big, it's hard for them to grow. Okay, these smaller companies can grow, you know, overnight. They can increase their revenue 50% on an annual basis on one contract type of thing. So, um, okay, let's see here. Um, okay, so here's another question I have from JW. I came late. What prices should we buy Yang? Can you repeat your strategy for Yang? Yeah, sure, absolutely, JW. So basically, I'm looking for Yang to hopefully come to the mid 60s before we take a position on it. Uh, you know, if it came to the 50s, I mean, definitely would be more attractive at that level. But I just think that you know, basically China is not done selling off, and there's a lot bigger of a hangover coming than these people realize. So, okay, I got another question that came in here. How many trades should we expect per month from David? You know, David, that's really going to depend on, you know, what's happening in the markets. You know, there could be periods where you have, you know, 2 trades in a day. There could be times where we have, you know, 4 weeks without a trade, you know, just because of what's going on in the markets. It really, you know, doesn't. It's not so much of a number I'm looking at. I'm just looking to help you guys make money. That's the bottom line. So it's really going to be reflected by what the market gives us. And I really don't have a way to give you an average, but you know, it's something that you'll see as the service evolves. You know, after, you know, we've been doing this for 2 to 3 years, then I can definitely, you know, then we can start putting out some averages and that type of stuff. But at this point, we just don't really have it. Okay, you're very welcome, JW. What sites do you use to stay updated on the market news? I use a myriad of different things, Mark. So one thing I really like to use is Twitter. Twitter is the fastest news source in the world. You know, what you can do is you can follow people like Bloomberg and you know, the Wall Street Journal, you know, Market Watch, The Street. You know, you can follow a number of different people or news sources. That's what I use to check news on the quickie spaces, and it's nice because you can search a certain you know, a certain search parameter and see everything that's been posted about it, and really be able to search through that real quick and find, you know, the most reliable resources, the most credible publication companies that are putting it out in that time in a very short period, as opposed to using Google or something of the sort. So. Yeah, I mean, really, Mark, I use, you know, Google. If I'm ever away from my desk, I'm pretty much constantly checking my smartphone. You know, check various different places on there. I check my brokerage, well, I have a couple different brokerages accounts, but I really like Thinkorswims because they really have a nice a newswire kind of feed that comes through. Definitely check that quite a bit, and they also have you know, various different things that are being published to the app. And so even if I'm away from my computer, you know, if I have a second, that's one of the things I always do is check to see what's going on with the news. So yeah, so that's pretty much what I use. Kind of a combination of Twitter, Bloomberg, if you have cable TV, is a great source. It's I think it's the least biased. CNBC, from what I've experienced, tends to be a little more biased, I think, than Bloomberg. And Bloomberg, just the data is a lot more accurate. Like CNBC will publish a story before they really kind of have solid evidence on it, and Bloomberg doesn't, you know, tend to do that as much. So that's why I kind of prefer to lean towards the side of Bloomberg for quality news. So hence why I used the Bloomberg details in our webinar today. Okay. So does anyone else have any questions? And if not, I'm going to go ahead and wrap up the webinar here. Like I said, guys, if you have any questions, feel free to email support at stocktradewire.com. I'll be happy to do my best to get you the most thorough and detailed answer as possible. So with that, folks, I'm going to go ahead and conclude the webinar. I hope everyone's had a great weekend, and we'll see how the markets react from the delay in Greece. Okay. So yeah, ONCS, JWS, can you tell us about ONCS? So yeah, ONCS, JW, I think we have an incredible opportunity with ONCS, and as my favorite saying goes, when there's blood in the streets, it's time to feast. So basically, I think we found an equity that's kind of at a discount. It's kind of ready to sell currently. And if it dips below, or if it hits $5.50 or dips below that, what we're going to do is we're going to build a pyramid, and however many shares you bought the first time on the first alert, around $7, you're then going to buy exactly that amount of shares at $5.50 or under, and we will definitely send out a trade alert when that happens. Okay. Will you tell us to leave if you feel things have changed? Absolutely, JW. Anytime we enter or exit a position, the first thing I do is send you guys an email to the fast of my human ability, and as fast as software will allow me. So yeah, absolutely. That's why you guys are paying for the service, so you can have me working for you full time, so you don't have to be doing the 40 to 50 hours of research a week that I'm doing. You can just replicate the advice I'm giving out. So you're very welcome, JW. It's my pleasure. And thank you. I hope you have a great weekend as well. And folks, the recorded version of the webinar will be posted in the site as well. So if you want to go back and and do the webinar again, feel free to. We'll have it posted to the site within 24 hours. It takes a little while for the video to render, but we should have it in the site within 24 hours. So I just got another question. How often do you do webinars? I plan on doing a webinar at least once a month, and I felt like this weekend would really be a good time to conduct a webinar, just because of all of the volatility that's happened, and there's just a lot of things that are happening in the markets that weren't on anyone's radar a couple months ago. So I thought now is a good time. Usually when things are volatile is when people have the most questions. So, but yeah, we can expect a once a month webinar. And like I said, next time, if you guys have any questions for me on the webinar, feel free to submit them. I'll try my best to pull up some charts and pull up some research, and so I can quickly go over your question in the actual webinar as well. So, okay, I think that should do it. Once again, I hope everyone has a wonderful weekend. That's my pleasure. Yep, let's I guess put on your helmet, Spartans. It's time for battle. I'll see you next week. Have a great day. Bye-bye.